Welcome back to my channel, everybody. Thanks for tuning in to another video. This is going to be a good one, going into detail on how to properly identify supply and demand levels, what to look for on a price chart, and basically how we draw out these zones and how I draw out these zones to find high probability areas on a price chart where the market can possibly turn with very low risk. So if you guys haven't already, please follow my Instagram. The link will be in the description below. I post trade recaps every day on my Instagram story. I post tips and tricks with options trading, tips regarding the supply and demand strategy, and just good details about trading and the experiences that I have gone through and go through every day. So if you haven't, the link will be down below. And by the end of this video, I'm very confident that each and every one of you guys will be able to properly draw these levels out yourself and how to spot imbalances on a price chart. So without further ado, let's get right into it. So I want to briefly describe how the market moves. I have a video on this. If you haven't seen it, I will link that below. But price only moves because of two different reasons. A, price is balanced. When we're talking about a balanced market, we're talking about market participants that are agreeing on a price. There's an equilibrium between buyers and sellers, and this creates massive liquidity, which is considered sideways and choppy or consolidation action. So if a market is balanced, you have buyers agreeing on a price and you have sellers agreeing on a price. Hence, price is basically stagnant. It's trading sideways in a very tight range because you have an agreement. Now, a lot of traders think sideways or choppy consolidation action is bad, and that is not the case at all. I look for balanced areas on a chart because usually balanced areas followed by an imbalance cause demand or supply zones to form. And that brings me into point number 2 of what an imbalance is. An imbalance is when market participants do not agree on price. So because they don't agree on price, either demand is going to exceed supply or supply exceeds demand. Hence, price will either go up or down. So what causes price to move up or down is an imbalance, an illiquid area of where the sellers were in control or where the buyers were in control. And that places all the orders that are going to facilitate on one side of the trade. The market moves up, then you have demand exceeded supply. And if that's followed, or if that is after a balanced period, then you're going to have unfilled orders sitting at that origin location where buy orders are going to exceed the sell orders. Same thing for supply. If market is balanced, followed by a nice drop to the downside, creating an illiquid area since all the orders were in favor of the sellers or the supply side, then once price reaches that balanced area where the market created that imbalance, you're going to have unfilled sell orders sitting at that origin location that did not get filled the first time since price basically fell too fast. And that is where that supply imbalance then occurred and was created. So I'm going to go into charts and show you how to find these imbalanced and balanced areas and how we can draw out these zones to then now take trades off of it in the real time. So this right here on Tesla, this green box, is illustrating an example of what a balanced market looks like. Like I said, a balanced market is an agreement between buyers and sellers, hence choppy consolidation sideways action. Now that is not always a bad sign. Also, we wait then for price to become balanced, followed by a demand move to the upside or a supply move to the downside, which then will validate and confirm that the balanced area will then leave unfilled buy or sell orders sitting at that rectangular box, waiting for price then to re-enter that area for those orders to be filled by institutional traders or the big money, the smart money. Retail traders do not move the markets. If the stock is rallying to the upside, it's not because a retail trader hit the offer for 100 lots. Institutional traders, like I always stress this point, but institutional traders trade with such large size that their orders will influence the market. So we have to trade with them and wait for price to then hit their orders again, and then we trade inside of that imbalance. Everything else when the market is balanced is just noise. We don't try to predict when the market is balanced. We don't try to predict when the market is going to become an imbalance. We then simply wait for confirmation, and then we hop in once price reaches our imbalance box, and we take the trade based off of that. Perfect example is then Tesla dropped into this area, and you could have taken Tesla long out of this demand zone. Now, this is not an indicator. I manually draw each and every one of these levels. I put price levels on them to label them because on different time frames, you are going to be able to see different demand or supply imbalances. Now, you want to be able to spot areas on the chart where the market is balanced, sideways action, followed by a nice move to the up or downside. Now, this is a 30-minute chart. And like I said, on different time frames, you're going to be able to see different balanced areas. We have a small body and a small candle here in this 30-minute time frame, followed by a nice move to the downside. This then qualifies as a supply zone because we had a balanced market followed by a drop, which then validates and confirms our point that at the basing candle, we had unfilled sell orders that did not get filled from this immediate drop from this big red candle to the downside. So then you fast forward into an intraday chart of when you're looking to trade these stocks or even the futures, and you wait for price to then re-enter the zone, and then you take it short because we're talking about supply because of the fact that these institutional sell orders will be getting filled once price reaches this box. So everything else is just noise. I only trade when a stock rallies into a supply zone to get short, and I only trade when stock drops into a demand zone to get long into. Everything else in the white space or not these imbalanced areas is just noise, and that's when you're going to get the high areas of false breakouts, choppy action that you're not going to want to trade because price is not getting filled by this illiquid area of a supply or demand zone. So price rallied into the zone, you took it short. On a 5-minute chart, you can see somewhat of this balanced sideways choppy action followed by a drop. So that's why it's important to go to different time frames because you're going to be able to spot different key imbalances or different basing candles followed by a drop or a rally. Now, if you fast forward this to today, price rallied into the zone and we rejected the supply zone, which gave us about a 8-point or 5-point risk to the for the supply zone to a 17-point move to the downside. So very low risk and very high reward and very high probability areas of where the market is going to turn. It's important to also make sure that the areas are fresh because if the areas are fresh, you're going to have more unfilled orders that are sitting at this level. So honestly, today, I wouldn't have taken this trade because yesterday price rode into this area and pretty much knocked out all those sell orders that were sitting at this imbalance. So today, when we rallied into it, think about it. There's going to be less unfilled orders sitting at that area. So it's very easy for price then to break through. And that's why used areas have less of a probability of working out because there's not that much orders or that wall of sellers sitting there trying to hold the stock down. Now I'm going to show you another example of how to look for a basing period. So here's an example on the S&P 500, and this is why it's important to flip through different time frames because they're each going to tell you different stories. The candles are going to look different on each time frame, and you're going to be able to spot different imbalances followed by balanced periods by looking at each time frame. Now right here I could see that price rallied, then we kind of stalled out. Now we wait for then price, since we stalled out, we wait for a direction after a basing period, and in this case, we made a move to the upside. So this basing period right here from this red candle qualifies as a demand zone because we based out, the orders were then balanced. Then the next candle, we had a massive rally to the upside, which then validates that there were all the orders were to the buy side, leaving this balanced period to have buy orders that did not get filled, waiting to be filled once price then pulls back into this area. And as you guys can see, price then pulled back very slowly. We were trading sideways, consolidating, but we hit this demand zone. This was from 3108 all the way to 3106. So this was a 2-point risk, and we got 20 points to the upside because of that. So that is a 10-to-1 risk to reward ratio. We're risking 2 points to make 20. That is 10-to-1. That is a no-brainer type of trade, and these demand zones have high probability areas of where the market is going to bounce or reject if you're talking about supply or demand. So now if you go into a 30-minute time frame, you're not going to see that same demand zone that we just drew. What you are going to see is you're going to see price that consolidated in this area. We had that agreement between buyers and sellers. So what you're going to see here is that this is going to be a balanced area followed by a move to the upside. So this qualifies this area as a demand zone. So now if you go into our candlestick formation that we look for, you're going to be able to draw this demand zone at this area 3112 to 3108. So you're risking 4 points. And if you were to get long at the overnight session at this demand zone, you would have got from 311 all the way up to 3122. So that's 11 points, and you're risking in this trade so far 4 points. So we're about 3-to-1 risk to reward right now. And this right here, bounced at demand. This would have been a great trade if you trade futures in the overnight session. This happens with any stock, any future, any market. It doesn't matter. Wherever there are buyers and sellers in any market, supply and demand will move price. The last example now is going to be on Roku, and this is on a 30-minute chart. Now, when you're plotting out these zones, it's always important for you to start at the highest time frame. Start at weekly, go down to daily, then 4 hour, then 2 hour, 1 hour, 30-minute. Just go down the list, and different candles will tell you different things. So Roku right here, price made a nice move to the downside from 111.5 all the way down to 106.25. So about a 5-point move to the downside. Then in a 30-minute period, this candle right here, price based out, where market participants, buyers agreed on the price down here and sellers agreed on the price down here. So we balanced out. Then the next 2 candles after that, we broke lower day, we made another drop to the downside, which then qualifies this candle right here of being a 30-minute supply zone. So I go here, I go to color, I make this a pink box, I change the transparency, and now we have a solid supply zone, which was represented by a pink box. You could even label the box if you would like to. Go here, edit properties, make it pink, and I label it 30-minute supply. Now, we wait for then price to either bounce at this area to take the trade short, or if it doesn't bounce, who cares? We do not take the trade. We only take it once price hits our supply or demand zone. Now, if you go to a smaller time frame, you guys can see on a 15-minute, you're not going to really see this balanced period as well as you did on a 30-minute. Go even further into a 5-minute, you're not going to see this balanced period as you would on that 30-minute. But like I said, price then rode into the supply zone, and you could have taken the short from 106.70 all the way down to 104 into the close. Not the best move down because this happened late in the day, but the reaction off of the supply zone is the only thing that matters, because these areas serve as high probability areas of where the market is going to turn. Going back to the 30-minute, you will see the structure that I look for, and then price bounced into it, took it short for a nice end of the day sell-off. So I hope this video cleared up some things for you guys, how to draw the zones, what I look for, and really the meaning behind it. It's a very powerful strategy if you use it properly. It's also very easy for you guys to mislabel zones, not draw them properly, and really take trades blindly off of a zone that you thought was proper when in reality it was not. So it's very important for you to draw valid zones and take the trades based off of them. So I hope this cleared up any questions you guys had. If you enjoyed it, please like the video, please subscribe. It means a lot to me. So thank you, and stay tuned for more future videos on this.